What's up everyone, my name is Joris, welcome back. When was the last time you checked your investment account? Do you know what your yearly average return is? And how much do you pay yearly in costs? You might be surprised by how much you are actually paying in fees. When investing in funds, some people are paying over 60% of their return in fees every year. That's right, 60%. In this video, we will look at the cost structures and how to avoid paying too much costs. The lower your costs, the higher your return. Or in other words, every euro you're paying in fees is holding you back on your journey to financial freedom. But before anything else, why don't you just click the like button down there for the YouTube algorithm and make sure that you are subscribed to the channel. It's free and it helps us a lot. Thank you very much. Ever since the implementation of the MiFID regulations in 2007, Europe has placed strict rules on the financial markets. Their goal was to increase competition, to protect the investors and level the playing field for the market participants in investment services. In 2018, these rules became even more strict with the MiFID II rules. One of these rules asks the financial institutions to give an overview of all costs related to investments that are made over the year on your investment account. Costs like management fee, taxes, and all have to be calculated and shown in detail to the customer. No more hidden fees. At least so you would think. All fees that have an influence on your investment throughout the year must be addressed on this document. But some costs can be excluded on the document. Costs like entrance fees, exit fees, or switching fees. So let's get an example here. Let's say you have 1,000 euros to invest on the 1st of January. You go to your bank and they offer you an active managed mutual fund. 100% equity, so 100% stocks in the fund. The fund has an average return of 8% yearly before costs. So you decide to invest in this mutual fund. Great, your first step towards financial freedom. But now it's time for the second step. You have to make sure that you earn the money and you have to limit the profit of the distributors of the mutual funds. You're the one running all the risk, so your investment portfolio is at risk, so you should get as much return as possible. The bank does not run any risk. They make money whether you win or lose money throughout the year. So let's look at the numbers. You want to invest in the bank's mutual fund. But before you can actually start investing and have your first shares of the mutual fund, you'll have to pay the entrance fees. Most banks charge around 2.5% fee here. This is a direct loss of your investment. All that money is lost from the start. The rest of the money will be invested in the mutual fund itself. So your 1,000 euros start capital is invested in the mutual fund and it's now worth on day one 975 euros, a loss of 2.5% from the first day. But banks do not have to show this loss since their calculation starts from the moment you are fully invested. The 2.5% fee is their commission and it's not linked to the investment whatsoever. So it does not have to be placed on the overview they have to show you. The mutual fund you're investing in has a running cost of 1.7%. These costs include management fees, transaction fees, and, let's be honest here, marketing fees for the mutual fund itself. You are paying for the marketing costs of the bank to promote the fund even further. At the end of the year, your management fund has had a return of 8%. Well, and 8% of your 975 euros invested, so you would end up with 1,053 euros, if only there were no running costs. The advertised running cost of 1.7% is calculated on the average value of your portfolio throughout the year, so not only on the profits, but on the whole value of your investment. So let's assume a stable rise throughout the years in your portfolio. At the end of the year, that's 1.7% on 1,014 euros, the average being of 975 to 1,053. That's 17.24 euros, meaning your end result is 1,035 euros and 76 cents. In this case, where you started out with a gross return of 8%, you'd only end up with 6.23%. But, and it's a very big but, you have to factor in the entrance fees as well, since you have paid them on day one. The 2.5% or 25 euros entrance fee you paid on the first day also limits your return. After 1 year of investing, your 1,000 euros ended up being 1,035 euros and 76 cents, a net return of a mere 3.576%, while being invested in a fund that has an 8% return rate. That is, if there are no exit fees or you haven't switched funds throughout the year. Of course, the entrance fee will not have such a big influence if you keep the fund for several years. But if you're accumulating your portfolio, you'll have to pay the entrance fee every time you buy more fund shares. It's definitely something to keep in mind. Now let's return to the numbers. You, as the investor, are running all the risk with your money. At the end of the year, you'll end up with a net return of 3.576% on your initial amount of savings, meaning 1,000 euros. And then we have the bank or broker. They run no risk whatsoever. They manage your money and they charge their management fees in the good stock market years as well as bad stock market years. In this case, the bank earns 25 euros entrance fees on your investment, as well as the 17.24 euros in management fees. That is a total of 42 euros and 24 cents on your investment. That's 4.224%. That's more than you have made. Of course, the bank has costs of their own and taxes have to be paid too, but still, the return is disproportionate to the risk that has been taken. If you make 3.576% and the bank makes 4.224%, that means the bank charges you 54.15% of your return. And they only advertise the 1.7 running cost on their commercial documents. Talk about good marketing strategies. The rate of entrance fees or running costs is extremely important. They make or break your return in the long run. If you can eliminate them or at least limit them, you're putting money back into your pocket right away. In the above example, if you manage to find a fund without entrance fees, and yes, they still exist, you'd end up with 1,080 euros gross or 1,062.32 net. Around 1.868% running costs on your initial investment and a return of 6.232 return net. That's better, isn't it? Well, in this scenario, the bank still takes 29.98% of your profits. So what can you do? Running costs of funds often lie between 1% and 2%. So if you manage to shave off a full percent of your running costs, you'll end up with a lot more at the end of your investment career. Now, let's assume the following. 3 brothers all invest 100,000 euros in a fund of their choosing. All funds have the same return, the only difference between them are the running costs. 3% for brother number 1, 2% for brother number 2, and 1% running cost for brother number 3. But it's only a few percentage differences, so no worries, right? Well, it's not much difference if you look at 1 year's worth of investing. But what if we look on the long term? So let's look at their returns when the 3 brothers compare them after 30 years. Brother number 1 has had an average return of 8%. And the running fees of 3%, resulting him in 432,194 euros. Brother 2 has had an average return of 8% as well, and running fees of 2%, ending result of 574,349 euros. The last brother has had a return of 8%, but his running fees were only 1%, end result 761,226 euros. A difference of just 1% in running costs results in a major difference over the years. The brother with the lowest running costs in his fund ends up with 329,032 euros more than the brother with the 3% running costs. Brother number 3 profited 76.13% more than brother number 1. What a difference a few percent can make. All is fair. An entrance fee of 3% is rather high and pretty uncommon. But the point here is how much difference 1% in running fees can make. Are there alternatives? Yes, there are. Banks market their own active managed funds to their clients, but they won't actively promote you ETFs, also known as trackers. These passive funds are traded as stocks and have their same transaction fees, which are often pretty low. But the transaction fee or entrance fee is a one-time fee. The main reason why ETFs are preferable are their running costs. Most trackers' running costs are less than 1%. A lot of great ETFs have costs of just a mere 1.2%. The costs are low since there are no transactions being made in the ETF itself. The composition of the fund remains the same throughout the year. So less costs, more return. If the average ETF has 1% lower running costs than the average actively managed fund, you are winning already. Now, banks often market their actively managed funds to be preferred over passive funds, while ETFs mirror the market and cannot really outperform the market because they are the market. Active managers can try to outperform the market or limit the downside in a bad market by changing their allocated assets. But a lot of studies have proven that 96% of all active managers fail to beat the market consistently. Even Warren Buffett advised his wife to invest all their money in passive ETFs instead of putting them in a managed fund. So, what do you think is better? Having lower fees and having it easy to invest in a passive fund? Or hope you will find one of those 4% active managers with higher fees that hopefully will keep outperforming the market? But why are actively managed mutual funds so popular and ETFs so unknown? Marketing. Big banks spend millions to promote investing to their clients, and if you invest in their funds, you are actually funding that same marketing campaign. Think of the three brothers and get rid of your fees. Make sure you get paid and make your broker work for their money. If you have enjoyed this video, be sure to leave a like and subscribe to the channel if you've not done that already. It helps us a lot. In the description below, I have linked other informational videos about how to invest in ETFs and how to start your journey to financial freedom. Feel free to check them out. I thank you for watching, and I will see you in the next one.